All right, good morning, everybody. Again, my apologies about the email. I hope it's getting out to everybody. They updated our email system this past Thursday into Friday, and I know I sent some stuff out last night, and looked like everybody got the problems and the quiz and exercise answers. So I'm hoping everybody got the Zoom code, but I am recording. So we will have a recording of this as we usually do that's on the YouTube channel so you guys can review that, okay? Going to be a pretty short class today. I know you had a lot of work this week with chapters 9, 10, 11. Give some people some extra time. Like I said, the priority was getting the midterm in, which I have seen most everybody turn in their midterm, been great. Everybody's scores have been in the 90s so far. I will email you personally your results, and I will also email out the answers so you can take a look at them, okay? So that we don't spend too much time today on that. As soon as we are done with class today, I will be emailing out the computer midterm, okay? I'll be emailing some instructions. I want them printed in a specific manner because on the main info sheet, when you do print it to PDF, it gives me the amount of time that it took you to do the return so that I can make sure that they're done timely and everything like that. We'll have a few days to finish it. But like I said, the big thing that I want to make sure is the time that everybody's taking to do it. So we'll have that and kind of take a look at that. It's hard with an online class. I can't really sit and monitor you and give you the midterm and watch you do it and help you. But I do for my classroom, I do give you one get out of jail free card, okay? So as you're doing the midterm and or you have get done with it and you have a question or something you're just not sure on, you're not quite comfortable, you can text or email me and I will assist you, or we can do a Zoom and I can kind of log in and see what you need help on, okay? So that way that you, just as you would in working in one of our tax offices. Obviously, it's open book. You can use any resources that you have or that you Pub 17s, publications, your textbook, the help menu within the TaxWise. Just as you would be in a return, or excuse me, in an office doing a return, you're going to have that opportunity to ask somebody and, get a second set of eyes, if you will, on a return. So we will make sure that that is the case, okay? All right. So what we'll do is we're going to do chapter 12. First off, before we get into that, are there any questions with any of the material as far as 9, 10, or 11, 9, 10, and 11, as far as any of the problems or any of the things? So if you want to type in the chat, we can do that. And I'm going to get things set up here for us so that in case anybody wants to talk about any of the problems, okay? Okay. Okay, we had a question regarding itemized deductions. Do we see any that people want to take that are not deductible? Yes, obviously the tax laws change. Some people are used to taking certain things. As we talked about with some of those itemized deductions, the medical, I want you to kind of always think outside the box to make sure that you exhaust, because medical is more than just your prescriptions and your copays and your eye doctor and your dentist. There can be other things that are in there. I think I brought up the fact that, those people that you see with the little dogs in their purse at the grocery store, okay? that actually is the one opportunity that you can put your dog on the return. If you have an anxiety disorder and you have a little dog that you carry in your purse so that you can go out in public with your anxiety disorder, then you're capable to deduct that. As far as other things, the biggest thing to remember with itemized deductions, especially when it comes to charitable, is did you receive anything, or is there an expectation to receive anything in return? All right. If there is that expectation, an example I always use, if you buy raffle tickets at the volunteer firemen for a meat raffle, yes, it's going as a nonprofit charitable organization, but you have an expectation of something in return. So that's very difficult to do that, okay? The other one, too, that with itemized deductions sometimes that people will have to go back and forth on is when we talk about job expenses, the ones that are subject to the 2% AGI rule on the lower part of the Schedule A. That's another one where we get a lot of times we have people that will give expenses. They have to be ordinary and necessary. All right, a little clue in there from number 4 on your midterm exam, okay? But ordinary and necessary, all right? If it's not something that you have to do your job, okay? Prime example is scrubs. Sometimes with visiting nurses that are on W-2s, they're reimbursed for their miles, but some of their equipment and things like that, they are not. Scrubs, it's tough. You see a lot of people wear those outside of work, but they are kind of specific to their profession. Steel-toe boots for a construction worker, certain tools for a construction worker or somebody that works in something that has tools. But again, if it's something that's not directly related. And the other thing too is some people have to have a cell phone to be reached outside of normal business hours and or internet at home. People will ask to deduct that, but you can really only do it based on the percentage that you use for business. Most people, I would say, probably less than 20% of the time, their own private cell phone and or their home internet would be used for job expenses. So those are things that we try to curtail a little bit, okay? Does that cover everything for you? Okay. Any questions on the problems sent out? I know there was a couple in there that had some little quirky things to them that with the answers on them. I don't know if anybody was off on something. There were some common errors within the class with some of especially the ones in chapters 10 and 11 that had that. And was everybody comfortable with all the retirement ones in 9? What I think I might do is I am going to, if you give me 1 second here, I think I'm going to bring up one problem from 9. I just want to make sure everybody's comfortable with the one. Let me just get my list here. Excuse me 1 second. Okay. All right. Let me just write something down here. Okay. All right, let me just get my problems here. I have them on a thumb drive I use from the class so that I can bring some up here. Okay. And I think we went through the problem in 9.2. We talked about, let me just do this. Hold on one second here. Okay. Okay. All right, so I'm looking at the problem. I think we did this one in class 2, but this is the one that was referring to Ralph, and he worked for the railroad, okay? One thing you want to make sure that when you handle those, that the blue, okay, you can see the blue one goes here. That's the railroad tier 1. That's the blue slip from the problem, okay? I know the books aren't in color, but I think in parentheses it does say blue. So you want to make sure you handle that correctly. And then the green slip is just handled as a regular 1099-R. So you can see here, RRB, okay? So where you see there on the box 1, you can see from the green slip in the book, the RRB line 7, okay? That's what you put in there, all right? And then if you notice that it has no taxable amount, so we have to use our simplified method at the bottom of the 1099-R. If you scroll down, you can see down here at the bottom that we have a simplified method that was in the book, okay? And that's what we use to do that one as far as the amount. You can see right there at the end that it has the railroad, the green slip from the railroad, line 3. You put that amount in. You put in, it said in the problem that he was a certain age when he started to receive this. So that's what you put in there for that date. And then it also says that he received it all year long. Okay? So basically what this is saying is, you calculate this remaining annuity. It calculates the taxable portion for you. After it does all that, the simplified method, it will carry it over to the 1040 page 1. Okay. This simplified method also comes up quite a bit with the Office of Personnel Management, the government. They tend not to put anything into that box for taxable amount. So same thing. You have to look at the boxes, understand which ones are which, and be able to use the simplified method and fill in the information at the bottom of the 1099-R to be able to get that taxable amount, because it is taxable on the federal. May not be taxable on the state, but it is taxable on the federal. Okay? So we will have that would be a little bit different. All right? Okay. The value in box 4, hold on one second here. In the green, there's nothing that you do with box 4, okay? You just use 3. If you notice, 4 has to do with the same amount that's on the blue slip from the Social Security. But there's nothing that we do with anything that is on the calculation on the 1099-R or the simplified method that we do anything with box 4. It's just kind of a informational type situation. Okay. All right. Okay. In Chapter 10 with the itemized deductions, you know, we got into a lot of the itemized with things. The one thing is that some people were off on like problem 10.3. Let's see here. I think also a little bit on 10.2. Okay, let's just take some look at some of these, and I'll kind of highlight some things on them. Okay, the big thing with 10.1 with Jason Garland was the things you had to distinguish between the two that were able to be itemized and that were not. Things like the dishwasher, car loan interest, credit card finances charges, those cannot go on there. Okay. You just had to make sure you distinguished on those, on the different ones on those, and make sure that you carried over on the from the W-2, the United Way, the 104, that you put that on your cash contributions. Okay. All right. So let me give me 1 second here. Let's see here. 1 second. I forgot the number here. Okay. Okay, we'll take a quick look at Jason Garland here. Okay, so Jason was single, pretty much just one W-2, but we did have quite a few things. Like I was saying on his Schedule A, he had some things in there where we'd have to add in. The big thing was, and a lot of times you got to be careful when you do the statements, especially from the 1098. We had mortgage interest, and you could add the points there, or you can see down here on line 12 that there's another spot to put the points. Okay, a lot of times people are forgetting to pull the points from the 1098. Okay, so you had to make sure on that. All right. We had the charitable contributions. Remember that for that one, we go in there to our charitable line. We can hit F9. It gives us that little detail worksheet. Once we go inside there, we can see our medical. Okay, we had miles and all of our total medical we added up. We had our church, and you can see this one for work. That was the amount that was on the W-2 that you could carry over. Okay, a lot of times we'll see this with area businesses where there's a $2 a week to the United Way, and that's where the $104 will come from. They'll automatically take it out of their pay as part of the charitable thing that they do in all their employees' names, and then they put it on the W-2 so that they can deduct it for the itemized. Okay, all right. You can put it on the W-2 as well and note it there. I like to reproduce the W-2 as exact as possible because there may be times where there's only one copy of the W-2, and that may be returned to the client in their packet at a later date. If they call us and they need a copy of their W-2 because, you know, there was a flood or a fire or whatever, we can reproduce an IRS facsimile, but you know, if it's not has all the information on it, then it's not going to be as accurate. But yes, I would put it on there. If you put it in box 14 on the W-2, it does not carry over to the Schedule A for charitable automatically. Okay. All right. Yep, and as I just said there, that it does, you have to enter it manually on that one. Always remember on the W-2 that box 12 will carry to a form. Box 14 on the W-2 is much more of a informational, so that you will just have it, you have to do it manually and put it to where it needs to go. So there may be information in there that you need, or it may just be informational strictly. Okay? All right. Okay. Let's take a look at another one from Chapter 10 here. Let's see. Okay. Let's do the one for the storms, because that had a couple things where people were getting a little off on that. They had some things that were pretty straightforward, but there was a couple things I just want to kind of point out there on that one. So give me just a second and I'll get that return up for us, and we can take a look at that. Okay, so we have the storms on their return. They had a couple W-2s, okay? Oops, okay. There's two ways to do things here, okay? One thing I want to point out is that New York State disability insurance, all right? Okay? One way that you can do it is under other taxes. It is deductible, so you can put state disability insurance, and they each had $31.20, so they had $62, okay? If you put it on the W-2, and you put it in this box right here, and you put it in as New York State disability, excuse me, you put it in as New York State disability insurance, and you put in the $31.20, and always make sure that you uncheck your box, okay? If you put in as New York State disability insurance, what happens is it carries to the Schedule A, and automatically, okay, so like I said, there's two ways, so you just make sure you don't get in there twice. It carries and it's actually added into line 5A, okay? So you can do it two ways. You can just call it state disability insurance, but again, if you recreate the W-2 and then where it shows New York State disability insurance, it will automatically carry to box 5A. If you put it under state disability insurance, it doesn't, and you have to manually put it on the Schedule A, okay? So it's just one of those things that, that you just need to be aware of, because right now this number inflated by an extra $31.20 because of what I had in here, okay? All right, and they had that on both those. The other one that was a little bit of a quirk on this one was the handling of the state. If you remember on this one, it said that they had a balance due for the state, okay? So it was a little bit different, all right? Okay. All right, so two ways that you can do this. It's going to go onto this form. The easiest way, it is a state tax paid, okay? So they had a balance due from the previous year. So if on the Schedule A, you go to line 5A, we go into the box there, we hit F9, we're going to bring up a worksheet that we can choose called F/S, standing for Federal State Taxes Paid, and that's 2016 payments. We go to this, we're going to discuss it more when we get later on, when we get into estimated payments, but at this time we're just going to kind of use it for the state tax paid for the balance from the previous year. So we're going to ignore the top. We're going to go down here. There's the state estimated, looks like a spreadsheet, but if you look here on the line right below that box, we have right here a little thing that says state and or local balance due from the previous year's returns paid in 2016, okay? So we would put that in there. That's where the 520 goes. Once we do that, since we came from that box on line 5A, the Schedule A, we can go back and that will be in there as part of that because we get credit for that as long as it was paid in the prior or in the tax year. Okay, if it's a case that they filed late or something like that and they didn't pay it in the tax year, then you can't take it. Remember, we're on a cash basis. Okay, so make sure that you have that one. The reason they need to include it is it adds to their itemized deductions. It'll lower their tax bill on the federal side. Okay, so that's why you want to include it. It seems fair, because if you think about it, if we itemized in the previous year and we checked that box in the middle of 1040 page 1, then we have to enter the refund that they had because it may be taxable. Okay, just to kind of little help you out for the midterm computer part. Remember that when we have, oops, hold on one second here so I can get to page. Okay, so in here in the middle, all right, they itemized, whoops, excuse me, they itemized last year, so this lights up. Okay, so here in the middle, we have check that they itemize, this tax refunds. If they have a refund from the previous year and they itemized in that previous year, then they must include that as taxable income. So it only seems fair that we can take it as a deduction also. All right. Now, if they have a refund and they have children, okay, and they had some of the refundable credits, I'm going to kind of jump over to page 4 here. Okay. So as you can see here, they have this Empire Child Credit. So let's say that instead of owing $520, they had a $520 refund. Okay, if they have a $520 refund, they should claim it as income on 1040 page 1 line 10. But before we enter that number, we have the opportunity to subtract any Empire or refundable child credit that they received. So in this case, we take the 520, subtract 660, we get a negative number. So that means they don't have to claim their refund. Okay, so that's probably a little clue I'm giving you away for the computer midterm. But those of you that are here today for the live lecture, just got a clue on one of the things that is on the midterm. Okay, so if you have a refund and it states something about a New York Empire's child credit, you get to subtract that credit from the refund, and then that makes the taxable portion. Again, if it's negative, you're going to enter 0 on line 10 of the 1040. Okay, is that clear for everybody? All right, that was just a little quirk that we were seeing in that one, as people weren't sure how to handle the state balance due from the previous year. You get to add it to your itemized, so it'll help lower your taxes. Okay. All right, so as far as paying it, okay, the reason that you put it on there is because it adds to their itemized deductions on the federal and lowers their federal tax bill. So any state taxes paid in the year, even the taxes paid with your return from the previous year, you can add to your itemized to help lower your tax bill on the federal. It doesn't impact your state, just the federal. Okay? All right, because it's taken out of the state itemized. All right, because if we look here, this is a state itemized, all right, and they would adjust it out of the state itemized. Okay, it's just that little perk. Now, the one drawback to this is right now, as of Thursday, if you follow us on Facebook, you've been hearing us discuss the tax law changes that are coming down. The U.S. House of Representatives passed the tax reform, if you will. State taxes, property taxes, a lot of these different things will no longer, basically they're trying to do away with itemizing, all right? And for a state like New York, where there's very high property taxes, it's going to hurt, okay? So if you want to go onto YouTube, there's, onto our Facebook, there's several places where Esther's discussed this with area TV personalities and on the radio and things like that. So we're trying to keep everybody posted. Website, we have a little sheet that kind of shows the impact on different things. So the tax cuts is not as much of a tax cut as you think. Okay. All right. Okay. And let's see. I was trying to think if there was any other of the problems that there was anything that came up on that anybody was having trouble with. Oh, one thing that came up in problem 10.3 about the Hodges is that somebody was wondering about the money for the cleaning solutions for contacts. That is deductible, okay? Cleaning solution for the is deductible, all right? It's kind of one of those things you have to dig a little bit to find. Same thing, make sure you handle your New York State disability correctly, okay? All right. Okay. All right, and as far as 11, let's see here. Again, 11.2 for Monica. She has, Tim's is pretty straight away. You just got to make sure you go through everything on the Schedule A correctly, okay? The one for the one for Monica, this is problem 11.2. Again, make sure you read the first bullet point. She itemized, and last year she paid state tax. So you got to make sure that you handled that one correctly, okay? All right. And I know the other one that came up quite often was in 11.3. People had questions regarding the police and fire department, those charitable contributions. Again, if you're giving to those, and most of the times those are like a benevolent relief or something like that, that is a charitable organization, that's fine. But if you're buying $25 raffle ticket for the meat raffle at the local fire hall, that's a little different because you have an expectation of winning something, okay? Equally, Girl Scout cookies on that one. For all those that still buy them, I always am a little disheartened each year because each year I get there, my favorite cookie has less and less cookies in the box and the price has gone up. But I still do support the Girl Scouts that I know. But you can deduct a portion of the Girl Scout cookies that would be similar to what they would pay for those same cookies in the store, okay? So that one was on the bottom of that one also for the Clemens return, okay? All right. Okay. Any other questions on any of the problems or anything about retirement or itemized deductions? Okay. All right. What we're going to do is we're just going to take 5 minutes. If you guys want to look back through anything for 9, 10, and 11, anything that I sent out, any of your answers, anything that might contradict, we'll talk about that. I'm just going to get us set up so that we can go through the lecture and do some problems on 12. Like I said, we'll be pretty short this morning. We'll wrap it up. I'll get you guys situated for the midterm so I can send that out to everybody. And then, like I said, I'll give you a little few insights. I gave you one when I talked about the state refund. Okay. Yeah, that state tax being paid, that's one that it's amazing the number of returns that we see that people do not handle that correctly when they come in as new clients. It's something that needs to be on that itemized. Okay. All right. So I will be right back with you shortly. Okay. Okay, everybody. We did have one question somebody brought up about the cookies. It's kind of mixed on the cookies. The way that that they look at the cookies is there's the price of the cookies, there's the price of the cookie themselves, and then a portion of what they charge for the cookies is something that is a profit that goes back to the charitable contribution. So if you buy it for $10, the value of the cookies in the box is $8 because that's what you pay at the store, then that $2 is all that you can really deduct, okay? That's really the way you should handle it. I know there's mixed where they say that they're not because, you should be given the cookies, but if you break down the total price of the box of cookies, into where it goes, obviously some of it goes to somebody that's making a profit by making these cookies and selling them to the Girl Scouts. But there's a portion of that is the markup that it goes to the charitable organization. So that's really the only thing that you can deduct on that. Okay. All right. We are going to start on chapter 12, adjustments to income. Not a bad chapter. Pretty straightforward. A lot of people see this one quite often with all the things that they do. We'll go through, we'll do a problem. We'll talk about some of the things that happened with the state side of New York. I realize some of you are not in New York, but we, since the office is based, we'll use New York. Again, I'm going to spend one of the class times when we have before the final to make sure that we have spend some time on all the various states that we do have for people that are participating in the online class. Okay. As it says here, we're doing adjustments to income. Okay. These are adjustments. They're not deductions that show up on our Schedule A, itemized deductions, and they're not credits that show up on page 2, whether they're refundable or non-refundable. These are adjustments to income that would lower our AGI before we move on to page 2 and use our deductions and calculate our tax, okay? So there's several lines at the bottom. We're going to kind of go through all of them and talk about each one of them. Where we have that, we've kind of got them outlined here, line 23, 24, right on down through the bottom of page, up to 1040, page 1, okay? We want to make sure that we just understand who qualifies for these and what those may be, okay? The first one, educator expenses. Trust me, every teacher is aware of this. Everybody that is an educator of some kind that has qualified expenses, they can get the $250. If it's a joint return and they're both teachers, they each get $250 so that they can do that. That's where the maximum is the $500, okay? But this is for somebody that is a teacher in K through 12, all right? And or an aide even, and they worked at least 900 hours during the school year, okay? It lists the qualified expenses. Make sure that there's everything that would qualify for these expenses. Again, we use the term that we saw in the midterm of ordinary and necessary, so make sure that we understand that. They have to relate directly to their profession and what they're doing with that, okay? Little snapshot of the adjustments to income. All right. The educator expense too, I want you to remind you that, sometimes you have teachers. Granted, I'm kind of happy. My last child is graduating from high school. I'm pretty much done with the school list because I swear each year I was supplying the entire classroom with the stuff that was on there. But, that's sometimes the teachers, that's the way they get supplies. Otherwise, they'd be paying for some of it out of their pocket, okay? But if a teacher has a case where they do spend more than $250, then the remainder can go on their Schedule A as a W-2 employee under job expenses, okay? I'll give you a prime example. I have a client. She's at one of the smaller rural schools. They don't have a very big school budget. She is head of the music and theater department, okay? A lot of the sheet music she buys, so she gets to her $250 very quickly. The other thing for her students that she pays for is so that they can put on a musical. A lot of times, over and above what may be donated, she purchases out of her pocket things for the musical, as such as costumes, scenery, supplies, maybe even the script, if it's a special script that they have to pay a royalty for. So those are things that she can add, and we put on her job expenses. And a lot of times with her pay, her union dues for being a teacher and some other expenses that she has within that 2% rule. You know, if it's an expensive musical and she purchases a lot of stuff, it helps her on her itemized deductions. So again, don't stop at the $250. You can always ask them, did you spend more than that? And again, you have to ask if they have it receipted. Okay. The next line, 24, talks about business expenses for reservists, performing artists, and fee-based government officials. I'll let you read through those. We won't spend a lot of time on those. There's just not a lot. You know, it's not common anymore with having anything on those. You know, it just, you know, it's a very narrow adjustment to income for anybody to take. So just make sure you understand what qualifies for those expenses and what they do with those. Okay. The next one is health savings deduction. Okay, HSA. All right. A health savings account has become a lot more prevalent. There's discussion right now with it because, you know, of a HDHP, as they call it, a high deductible health plan. A lot of times, even employers now, used to be you had a very nice plan with your employer that you had paid insurance out of your paycheck. Then you went to the doctor or whatever you did, and you just had a copay. Well, now, because of the expense of health insurance, you know, a lot of it due to things that have evolved from this Affordable Care Act, employers have high deductible options so that somebody doesn't have to pay as much for their insurance. They're not getting the Cadillac plan or the top of the line platinum plan. Okay. So with that being said, then you can contribute to a health savings account. All right. Health savings accounts are great. You can set money aside, and again, tax-free in, tax-free out. Okay. So if you put money in there from your W-2, there'd be a little W code in box 12, and it'd be a contribution to your HSA. It lowers your taxable income on your W-2 in box 1. And again, if you contribute money outside of your W-2, say out of your checking account, you put an extra $100 a month in there, a family, married filing joint, can right now put up to $6,700 in there. Okay? So it's a great way for you to do that. As it says here, here's how you have to be eligible. High deductible plan. You cannot be on Medicare. You cannot be dependent on another person's return. Okay? And you might have disqualifying insurance, or your employer might be giving you an FSA. Okay? HSAs roll over year to year. Okay? So if you don't use it, you get to carry it forward. FSAs are the use it and lose it proposition. That's given to you sometimes as a little perk. The insurance company to the employer says, we'll give each one of your employees a $250 FSA so they can use it. You know, that's a use it or lose it proposition. Okay? Here's the limitations when it talks about a high deductible. Okay? So these are the high deductible plans and what qualifies for those. All right? Also shows the maximum the maximum out-of-pocket amounts that show up on that. All right? Okay. Here's several of the little things that we talked about with the HSA. There's several things there that, kind of tell you what the benefits of those are. It stays with the taxpayer. As it says, it's portable. Okay. Another thing with HSAs that a lot of people are not aware of is as you reach retirement, if you have a high deductible plan, you're healthy, so you've chosen through your employer to take a high deductible. You can take money out of your W-2. Also, as you get older, you can do a little bit of a catch-up. You can put money into that HSA, and you can use it in your retirement. Okay? HSAs can be carried in retirement. Once you're retired, you can use it to pay the premiums for your Medicare. You can use it for obviously all of your medical costs. The other thing is, once you're of full retirement age and you take out, you put money that you have in an HSA, the one that goes out at the end of the year is the FSA, flexible spending account. Okay, HSAs roll over. All right. The thing in retirement, if you have funds in there, once you're no longer working and of full retirement age, your HSA kind of becomes a hybrid. You can still use it for medical and pay your premiums on your Medicare, but you can also take money out of it like as a traditional IRA. There's no penalty because you're taking that money out. Good example, I have somebody that has we've built up their HSA. That money's in there. They have over $10,000. They'll use it to pay some of their Medicare Advantage plan for the premium. Also, if they have the event that the furnace goes out in the house, okay, maybe they can use that like a traditional IRA, take money out. It is taxed like a normal traditional IRA, but you can take it out of your health savings account and only pay the tax on it, okay? If somebody takes money out of that prior to that point, then there's a penalty for it for not using it for qualified medical. So you can ignore the penalty on that, okay? So that's one of the benefits to it, taking that HSA into your retirement. All right. Here's the contribution amounts, the limitations that I was talking about here. You can see that they have, right here in the middle of the page. Whoops. Right here in the middle of the page. What's happening here? Okay. All right. So we have that. You can see the maximum contributions for the self and the family. And then, like I said, there's that little extra catch-up you can do once you hit 55. Okay? Again, you can roll these over and take them into retirement. They're not going to do anything on there. If you make excess contributions, though, there is a penalty also. So you can't put more than those limitations. Otherwise, there's a 6% penalty there for that. Okay? All right. The sheet that we report the HSAs on, like I said earlier, there's a the HSA. If you leave an employer, typically it just goes with you. That's where the portable thing comes in. Generally, that HSA is a separate account, set up almost like a little credit card account, or you'd have like a debit card on it. If you leave the employer, really it's not tied to them. It is your money. Even if you change insurance companies, you can use it. It's almost like it's freestanding. Okay. Here's the 8889 that has where we have the form. 8889, again, if we have a W on that W-2 in the box 12, it'll say that there was money taken out of their paychecks going into a health savings account. And so we'll have that. This page is really just reconciling to make sure that you did not go over your contributions, and equally that in the bottom part, the distributions, that you use them for qualified medical expenses. People will get a 1098 and it'll have all the information on there and show all the different information that you need to have for that. Okay. Moving expenses. All right. A lot of people forget about this one. Moving expenses on there when somebody moves. We're going to talk about who can take the moving expenses. All right. Moving expenses are deductible if all three of these are met. The move is closely related to the start of work, the distance test is met, and the time test is met. Okay? As far as the distance test, all right, it's basically saying that you have to move more than 50 miles. Okay? Up here in New York, we always have to do a very tight test if somebody's moving back and forth between Buffalo and Rochester, because there can be sides of Buffalo and sides of Rochester that are within 50 miles of each other. So even though they may move there for a new job or to a new workplace, they might not qualify for the moving expenses, okay? So you always have to do that distance test, all right? Great little illustration of the distance test here. Talks about which one that you can meet in order to meet that distance test and the things that go on there. A time test, okay? An employee must work full-time for at least 39 weeks during the first 12 months immediately following their arrival in the general area of the new job location, okay? So if somebody moves temporarily, okay, and they're just going to go somewhere and see the job market and they do get employment, you got to be a little careful on the time test, all right? because you don't want somebody just going somewhere for less than a year trying to write off the moving expenses when they weren't really moving for a job and being employed as the time test says. So you want to make sure that that time test is met, okay? There are some exceptions to the time test that is listed here, okay? It does say here, which is always a question everybody comes up with, what if the time test is not met before the return is due, okay? Then, if they took it in the previous year and they didn't meet the time test because it lapped over into 2 tax years, they would have to go back and amend their return, all right? And they would probably have to pay back any credit that they may have received on that, all right? Deductible moving expenses, okay? We have moving household goods and personal effects, including in-transit and foreign move storage expenses, and travel, including lodging, but not meals, to the new home, okay? So, you know, you rent a Penske truck. Maybe when you get there, you have to wait a month for your apartment or house or whatever to be ready. You store it. You know, you have hotels because it's a long trip. You know, different things, lodging, you know, long trip, you have to stop overnight, okay? The one thing, too, about the travel with the car is that you can get a rate of 19 cents per mile. The thing is, if, say, you're moving from Buffalo to Arizona, okay, you've gotten fed up with the winters and you decided to go to Arizona. Well, in order to deduct the miles, it's got to be your most direct route, okay? You can't drive down to Tennessee and stop and see Aunt Betty, and then drive maybe to Nebraska and stop and see Uncle Bob, and then maybe take another little jaunt into Colorado just because you want to see the mountains, and then head down to Arizona. You can't do that. You can't do all the lodging and stuff. It has to be that most direct, okay? We're not going to pay for the vacation, and as the IRS says, and they've always determined that you must eat, so they do not pay for the meals, okay? As it says here, non-deductible, sightseeing tours or stops over during the move, okay? Anything with the purchase of a new home, driver's license, auto, so basically it has to relate directly and necessarily to the moving expenses, all right? The one thing that does come up too is a lot of people, if it's an employer where they're transferred from one office or city to another, it may be the case that they're reimbursed. All right, if you're reimbursed for that move, you can't deduct that because you've been paid that, okay? So this is where it talks about that accountable and non-accountable plans to see how you handle your reimbursements for anything that would show up on that, that form, okay? The form we use is the 3903. Again, we have some line-by-line instructions. Pretty much it works great as the interview, okay? You can go right into that form and you can see, did you have any transportation, okay? But on the form in text-wise, even before they begin, you can, there's a little thing up above and there's a little worksheet, just like you see right above that, that says, do they meet the distance test, okay? Then you can get in there. Did you have transportation and storage of your goods and personal effects, okay? Travel. Did you travel from your old home to your new home? Okay. With the meals and stuff like that. All right. Enter the amount your employer paid for your expenses listed in lines 1 and 2 that is not included in box 1 of your W-2. So again, if they paid there, you know, there'll be things that'll show up on that W-2 as a code P. You have to make sure that you back that out. Okay. All right. If they don't know, okay, if they don't know the distance, that's where Google Maps is probably the best bet, okay? Because like I said, if they've decided to make any little side trips, you know, your job is to say, hey, you know, the best and most, you know, straight line between A and B is this, and you can look it up on Google Maps and get that distance. And also, you know, that gives you too, nice thing about Google Maps is sometimes it will determine the amount of hours that it takes to drive. So that's where, maybe things can come up. They spent 3 nights, but really, you could have driven it with 2 nights. Okay, so you got to make sure that you're really things that are directly related to the moving. All right. All right, self-employment tax deduction. Kind of a little early preempt when we do next week, or excuse me, after Thanksgiving. We got a little break in here, but next week after Thanksgiving, we will have where we talk about business income, and that's where this comes into play. Comes into play for some other things too, but the big thing that we see with it is the self-employment tax deduction. We'll talk a little bit more about that. So, really what this is that when you have profits from your business, you must pay self-employment tax, which is Social Security and Medicare, on the tax return. Just as your employer pays that for you when you're a W-2 employee, they get a credit for paying that. So you get to subtract half of your self-employment tax on your tax return, okay? And again, we're going to see this when we get into chapter 13 and 14 with business income, that we'll have that. It also comes up with self-employment if somebody is a partnership that comes over from a 1065, or it may come into play when somebody's a minister or that does not pay Social Security and Medicare on their W-2. They may have income when we talk about ministers as far as how they handle their taxable income. A lot of times on their housing allowance that they receive, they may pay self-employment tax. Okay. All right, we have deductions for self-employed for people that participate in SEPs, Simples, and qualified plans. Okay. We have all these. They describe what each one is. SEP is that Simplified Employee Pension Plan. You see at the bottom of 1220. Simple, Savings Incentive Match Plan for employees. All right. And qualified plans, there's things that describe there, solo 401ks or things that they may have for those that are self-employed, okay? So it says here, SEP, Simple, and qualified plans offer the self-employed taxpayer and their employees a tax-favored way to save for retirement. Contributions a taxpayer makes to the plan for the employees can be deducted, okay? A sole proprietor can deduct contributions they make to a plan for themselves. All right, so it's a way, instead of what may show up on the W-2 for somebody that has a 401k through their employer, this would be a way for somebody that's self-employed to capitalize on those contributions to lower their taxable income, because it may not show up even if they working for a sole proprietor on a W-2, it would give them the opportunity to make these contributions, okay? Talks about the different qualified plans that take place. Again, we'll see some of these when we get into things with self-employment, so we can kind of see how they carry off the Schedule C. But just remember, it's another way for somebody that is self-employed to lower their taxable income. Okay. Moving right along to line 29. Self-employment health insurance deduction is covered in Chapter 14, okay? So basically, we're going to talk about it there when we get into Schedule C, because you're self-employed and out of your business, you're a sole proprietor. The Schedule C that shows there, you would pay your expenses for your health insurance out of there. You can deduct them, okay? We'll talk about which of those are deductible there, all right? If you remember back to our penalty on early withdrawal from when we did 1099 INTs and things like that with that unearned income, on that 1099 INT, there might be a penalty. Somebody took money out of a CD or some type of interest-bearing investment. Well, if they did it before the maturity date, then there may be a penalty. Well, you get to deduct that penalty when you take that out, okay? Just the penalty, all right? Okay? Alimony, okay? Alimony paid. So obviously, if somebody, when we talked about unearned income, we talked about alimony. If somebody's declaring alimony as income, they're going to allow the person on the other side of the equation to deduct it. And again, it is just alimony, okay? We talked about what alimony is taxable, okay? Child support, maintenance of the house, things like that, that is not alimony. That is not deductible, okay? It has to be alimony, and it has to be claimed by somebody else's income, all right? Alimony requirements here. It talks about all the things that relate to those. Just make sure you understand what is alimony. I know in New York, sometimes they will call it maintenance if it's paid to the former spouse, okay? So sometimes that maintenance word does sneak in there, but again, it has to be the intent of alimony. Can't be maintenance for the upkeep of the home. All right. All right. This is a big one because this is one we see a lot of people use. One thing before I forget, alimony on the last one. That is one that may disappear under the new tax law. They're talking about doing away with people having to pay tax on alimony. Also, that equally, then people would not be able to take it as a deduction if they're paying it. Okay. So depends on, I guess, on what side of the divorce you're in. You're going to be happy with that or you're going to be upset with that. But obviously, you know, that's one of those things that could change with the new tax law. Okay. IRA deduction. This is one we use quite often because it is an easy way for us to lower somebody's taxable income. All right. Because we can make these contributions after we've looked at their taxes. They basically have until the time that the tax return is due, which most of the time is April 15th, to make this contribution. So I have a lot of clients that come in, they'll begin in February. We'll do the return. If they have a balance due or they have the extra income, they can basically make that contribution to an IRA to try to lower or, basically like they would with their employer plan, make pre-tax dollars into a traditional IRA, okay? Contributions are a little more limited than what we might see with a self-employed person with the SEPs or Simples, or you might see with your own 401k. Your own 401k, you can make up to $18,000 contributions out of your income. You can go over that if it's the employer match it, but yourself with payroll deduction, you can contribute up to $18,000. In this case, it's pretty much limited to $5,500, but you can do a little catch up if you're 50 and older, $6,500. Okay. The way I explain this to people is when you contribute to an IRA, basically you're stretching the value of your dollars. All right. It's not a dollar for dollar like a credit would be to eat up your tax bill, but it is a way to stretch. It may be the case that if you put $5,000 in there, it might save you $1,500 on your tax return, okay? That $5,000 that you now put into that retirement account not only is going to grow and make money for you, but the $5,000 that you put in there really only cost you $3,500 because of what you saved on your taxes, okay? And it may be the case that $1,500 savings could swing somebody from owing money to getting a refund, okay? So it's a great way to talk to people about investing in their retirement and equally to really manage their refund or their tax liability that they may have at the end of the year, okay? We talked about retirement plans a little bit, which ones are pre-tax, which ones are not. Just remember, traditional IRAs, those are ones that we can contribute to that are going to lower. If you do it to a Roth, it's not going to lower your taxable income because you're putting tax dollars in there, okay? So we have to make sure that we understand that. Now, equally, there are situations with high employed people, okay? Yes, they should make the contribution, but it is the instance sometimes that they will say, hey, what if I put $2,000 into my traditional IRA? Sure, I'll put it on the return. Then it's up to them to make that contribution because they will get a statement that shows that they did that. Some people come in with a Form 5498 that they made a contribution before the end of the year, okay? Trust me, if they tell you that you're going to put on $2,000 in there and they fail to, the IRS will catch up with them and there will be a severe tax penalty, okay? So a lot of my clients will be good and they'll go and make that deposit and bring back the slip for me that shows that they did it at their bank, or if they did it before they came in for their taxes and before the end of the year, they'll get a 5498, which is basically a document that shows the value of a retirement account. And on there, you can see the contributions that they did make. Some people budget themselves and do a monthly checking account deduction and put it right into it. Okay. Non-deductible IRAs. Prime example, had a gentleman in the other day, and I had to explain to him, he was making contributions to a Roth in his wife's name, but his income was too high to make these contributions. So it was basically he was paying a penalty on his tax return for excess contributions to a Roth IRA. That being said, it was basically that he was paying a 6% penalty, all right, for every year that he was doing this. Also, that is a snowball. So if you leave that extra contribution in the IRA, it adds to the next year. So he was up to about $25,000 at the end of 5 years that was being taxed at 6% each year. So each year that it grew by the 5,000, he had another 6% he had to pay. The way to correct it is that he can only correct it to have that stop happening is taking that 25,000 out of the Roth. He can leave the growth in there, but he has to take the 25,000 out of the Roth and put it somewhere else so that there's not a penalty that's happening for that. So there are things that, you know, that you pay tax with conversions or excess contributions or distributions, things like that, that you have to make sure you understand the tax consequences on those. Okay? All right. Okay. We have a little bit of the phase out here with the retirement works and plans and things like that. Here's what I was talking about. If you're not covered by retirement and then your income's too high, he was over 194,000, married joint, he can take no deduction and then it becomes an excess contribution. Okay. All right. Student loan interest. Okay. Going back to the IRAs, I encourage you to play with these. Okay. What I mean by that is when you get done with one of your tax returns and you see something, say, okay, what if I do an IRA deduction? What if I do this? What if I contribute too much? You know, see what it happens. That 5329 form, if it's something that should not be contributed, that 5329 will come up. You can go look and say, oh, it's an excess contribution. He's covered by a plan. He's, you know, all these different things. The IRA deduction when you're with somebody to help them manage their tax liability is a great tool, but you have to understand too that it's not just a great tool that says, okay, we'll put 5,000 in there and then they'll lower their tax bill. No, there may be circumstances that do not allow them to do that, or it would generate more of a tax liability. Okay? All right. So we have next student loan interest deduction. Obviously, student loans are a hot topic. Okay? Student loans have surpassed credit cards as the second highest debt in the United States. Okay? $2,500 is the maximum that you can take on any return. For the interest that you paid, that's only what you can take, not the principal. Trust me, with $2,500, a lot of people get to that very quickly because the amount of student loan debt, all right? But they can deduct that. Now, the one thing that's tough about this, if they are somebody that went to a lot of grad school or post 4 years, post bachelor's, so that they could get a really good job, is that there's a phase out, all right? If they've ended up and they and their spouse are making more than $160,000, they are not going to get to deduct their student loans. And they may have, if they both went and got an MBA or something, they might have a ton of student loan debt, but they're not going to get to deduct the student loan interest, all right? So it is a great deduction, but again, sometimes it phases out, okay? The form generally that you're going to see is the one that you see here, the 1098E, all right, the student loan interest statement. So that is one that you would see for this, would have all the information on there. And again, you know, it has the recipient's, the borrower's social security number, who is they paid it to, and the student loan interest that was received by the lender. That's what we're able to deduct. On the form, we may see it in action here. I can't remember if we have in our problem that we're going to do, if we have any student loan interest. I don't think we do. Nope. But if you do have that with the student loan interest, you can put in over the $2,500 amount, and it'll automatically, within tax-wise, roll it back to $2,500 or phase it down depending on their income. Okay. A couple of problems here for you to do with some exercises on the student loan interest. Okay. Tuition and fees. All right. Kind of an odd little item that's on the adjustment to income that we don't see a lot. We touched on it a little bit when we were talking about the education credit. If somebody's not eligible or the education credit is beneficial, it might be the case that the tuition and fees deduction would maybe be better. We're going to take a look at it when we do the problem, so you'll kind of see it in action. But as you can see here, the tuition and fees deduction can reduce the amount of income subject to tax up to $4,000. So $4,000 is the maximum that you can do on the return. Okay. All right, so we'll kind of talk about that. A lot easier to see it in action, but again, same rules pretty much apply we saw with our education credits. Qualified education expenses, they were for an eligible student. The student is the taxpayer, their spouse or dependent, somebody on the return, and we'll see that with the form. Okay. All right. And again, we kind of go through a lot of things that we saw with the education credit that we have that were part of the questions and the qualifications to be able to take the American Opportunity or the Lifetime Learning Credit. Okay. All right. So that is our adjustment to income section. Okay. So that's chapter 12 for us. We're going to take 5 minutes. Be right back. If you want to get ready with your workbook, I'm going to do problem 12.1 here on the screen. I'm going to get it set up on our break. But it'll be Howard and Janet Hamilton. We'll talk a lot about these credits, okay? So we will be back shortly. Okay, we are back. As I said, we're going to do, we had one question as we were going into break there about the education, the tuition and fees deduction. Yes, you cannot double dip, so you cannot take the tuition and fees deduction as well as one of the education credits. I tell everybody that each year, based on all my classes, I do give a double dipper of the year award. I usually give an ice cream scoop to that person because I tend to have that person that likes to put things on more than one spot. And just as a reminder to them, I try to give them that award so that they will stop doing that. So, but yes, that would be a double dip. Okay. All right, so we're going to do, as I said there on page, let's see, 167 in your book, that we're going to do the Hamiltons, Howard and Janet. So we'll get them set up here and get the file open for them. If you want to start looking at some of the bullet points there, you can do that. Okay. Because there are some things that are information within the bullet points there that we can talk about. Okay. So we have Howard Hamilton. And we have Janet Hamilton. Oops. All right. The reason on this problem that they did a 1040, but they were not itemized, it might have been some of the things that we're talking about with the adjustments to income. Some of those may not be on the 1040A. So they may just not. The important part of with it saying that we're not itemizing on this one has to do with the fact that since we didn't itemize last year, we don't have to claim a refund for tax liability. Okay. All right, so they're Johnson Avenue. We're going to say they're living in Amherst. We have an email for them. Actually, we'll just use hamilton@gmail.com. We have, let's see, Howard's birth date. All right, and we have Janet's birth date. Okay. He is a principal. She is a teacher. So it sounds like we have to start thinking about our education expense. They do a married filing joint return. They have a son, Scott. On there. His birthday is Valentine's Day. Okay. And he lived with them all year long. Okay. All right. They're New York residents. Again, you know, we'll try to do some other states later on so we can see everything that goes on with those. They have stated that if they get a refund, they want to handle everything electronically, so we'll need to put their bank information in the return. Okay. Get their pins in there. Again, I use just use their zip codes. All right. License number, you'll get that when you have them do the information. They'll put that on there. A lot of the states require that now. All right. Oops. Okay. As the question was, you know, that says they did itemize last year. Okay. So we're going to put on there that they did on a 1040. Or excuse me, they did a 1040, but they did not itemize. Okay. So that's where we can keep from them possibly having any balance due on their line 10 there, any tax liability. Okay. All right. So let's start with page 169 before we come back to the bullets. Well, one thing we will do, we'll clean it up real quick, is the health insurance. They were covered through an employer plan the entire year. Okay. All right. Okay. So first thing we're going to put on there, they have some interest income. So remember, we're going to go to 1040. If we go down, we can get on our interest line. We can bring up our Schedule B. But as we've talked about, interest and dividends go on the B, but not directly on the B. So we're going to go into that line, bring up our little interest statement worksheet. So we have the little worksheet here. We can see here that they had from First National, they had interest in box 1 of $564. No state adjustment. That would be only the case if there was bonds. But we do see in box 2 that they had $25 for something they took out as an early penalty. Again, that's going to show up on our adjustments to income. So we put that $25 in. We go look at 1040 page 1. We go down. Sure enough, line 30, there is our $25. Okay. All right. So we have a W-2 here. The first one we have on page 169 is for Janet. So she would be the spouse. Make sure you're checking the correct boxes up there. We have her address information. She is at United Local School. So we have her. Okay, we have her employee identification number. We take a look at her pay. She has her pay in there. She has her withholding. And again, if I see this withholding, I'm thinking this looks a little bit low. but we may be all right. Okay, so we have that. Nothing, we're going to take this out, so nothing in box 14 on this one. And then down at the bottom, remember, out of sight, out of mind sometimes, but make sure at the bottom of the W-2 and at the bottom of the form of the computer, you get in that state withholding. Okay? All right, so we have that. And we have those two done. Okay? We're going to go on. I'm going to hold off on the tuition statement because we're going to come back to that one in a second. But I am going to do Howard's W-2. So the way I like to do this one is I usually go up to the top to my tab and I copy my W-2. Gives me a blank one. This one is for Howard. He's the taxpayer. We have his address. We have his employee identification number. All right. And we have his pay. Now, if I take a look here, I want you to observe on this one because this is a little thing that we need to make sure we point out. In box 414, or box 14, he is taking part in a 414H for $3,000. Okay? So, if I put in the income here, all right, and I put in his withholding, all right, and I go down here, here's my 414H. That's why this is in here this way, and I'm going to show you how to handle this, okay? So what we need to make sure that we do is we put in that amount there, and it's $3,000. If they qualify, it would be eligible for the 80, so we want to leave that checked. But this is like a contribution. These are pre-tax dollars. So if we look back up above and we look at our W-2, we can see that this did not change. Not like when we do the D over here in box 12. This one is the same type of account, but it should adjust it. So what we need to do is we need to go up and we need to take the calculations off of lines 3, 4, 5, and 6. As you can see in 3, 4, 5, and 6, they turned green. So now I can go back to my W-2 and enter the amounts that are on the W-2 just as they appear, okay? So I've taken the predetermined calculations off, and I'm going to have to put it in manually. That's kind of unique to what we do for a 414H, okay? Now, the 414H, SUB, it is a state pension fund, okay? So they are contributing that as pre-tax dollars, so you get to take it off of the taxable income on the federal, but on the state, if we go to our New York 201 page 2, we look here, we have to add it because it is taxable on the state of New York. So you can see our federal income, then that would be what we saw from the Fed because it's lowering our taxable. But on the state, we have to add that $3,000, okay? That's just the way that's handled. That's why you always see that 414H SUB on the W-2s as a default because it has to be handled correctly. Otherwise, New York State sends you a letter and you get a lot of tax and penalty on this, okay? So just make sure you're aware when you see that 414H, okay? All right, and then back to the state withholding. We had his state withholding, 2520, okay? All right. Like I said, I'm going to come back to the 1098T in a second, okay, because we're going to handle that a little bit different, all right? First thing we're going to do is we go along here. Howard is a principal at a local high school. He spent $121.22 on supplies for his job. Okay, he's an educator. Remember, we can do for each of them, the husband and the spouse, the taxpayer and the spouse. So we're going to go down to our adjustments to income, go to our line, F9, here's our worksheet, okay? Basically our education worksheet, all right? Student loan interest, we don't have anything right now on that, okay? This is where we would put that in. Like I said, you know, the maximum is $2,500 total. So, you know, you put that in, it's always never going to go more than $2,500 unless it's phasing out, okay? Educator expense. So this is for the taxpayer. We have $121.22, okay? For his wife, she's a full-time first grade teacher, and she spent $321. Okay, now, $250 is the max here. So we need to take, oops. All right, so $250 is the max. and the remaining $71 would go over to the Schedule A if we itemize. They do not itemize, but if we were going to put it here, we would go down, subject to 2%, would go under the job expense. All right, so if they spend more than their $250 that is an adjustment to income, we can put it down here in their unreimbursed employee expenses. Again, has to be to their discipline. All right, so just make sure that you realize that if it's over $250, you can still use it if they itemize. All right, so we have that. Next, Janet would like to contribute $2,000 to a retirement plan. Okay, on the retirement plan, we forgot to check our box there for the retirement plan for Howard. If we look at her W-2, we have to see that she is not, in box 13, she is not covered by a retirement plan. So we're going to go and we're going to do, all right, she's going to compare to a retirement account. First thing I want you to do is look at the blue box in the top left corner. You can see the balance due of $187. Let's see if this IRA deduction is going to help us. So we go into line 32. We hit F9. We bring up our little worksheet for IRAs. Okay, and it has it there. All right. Up at the top, if you notice, based on what we did on the W-2, it'll help us determine if they're covered by a retirement plan or not. Okay. She is doing a traditional IRA. Okay, she is not. So it shows the maximum amount that she can contribute. We're going to put in $2,000 for her. All right. So we put that in there. If you go back up and look what it did to her refund. Okay. So we went from owing about $180 to a little over $100. So that's roughly about a $300 swing. Like I said, $2,000 she put in there really only cost her $1,700 because she saved about $300 on her taxes. Okay. Neither one of them got any distributions from anything. Okay. So we don't have anything there. Janet enrolled part-time in a graduate program at your city teachers college. She received a tuition statement. So we're going to go take a look at that. Okay, hold on one second here. You can, but you may be limited, and if you have, depending on your income, it can be excess contributions. Okay, so it's kind of not a specific yes or no, black and white, if you can contribute to a 401k and an IRA. If you look up here, kind of tells you you're covered by a retirement plan, a 401k. All right, so filing status single or head of household. Okay, all right. There's the limits and what you can do. All right, you can see here he could contribute. So if I put $2,000 in there also for Howard, okay, he's covered by his retirement plan, but I put $2,000 in there for him. It does allow him to contribute. No 5329 over here. Okay. Now, if I put in there 7,000, okay, I can see over here on the left, if you look, that 5329, he contributed too much money and he has a penalty. Okay, so like I said, when you do these problems, you know, you can kind of play with them a little bit and see what does and doesn't qualify for those, you know, based on their income and things like that. If anything that you do on those contributions, SEPs, Simples, IRAs, Roth IRAs, you can see what it does and if it generates the 5329 to make a penalty for them on that. Okay, so we'll take that out of there. So like I said, there's not really a yes or no answer to that question. It just depends on the income and what they contribute to. Okay. If we look down below, $6,500 is the allowable amount. Janet still has $45 she could put into a Roth. So there is income on that side of it. Okay. All right. Now, we have Janet. This is why I kind of saved this to the end. We have Janet. She is taking a tuition statement here. All right, so she has that. So the first thing we're going to do is we're going to go where we normally think to go that we've learned already. We're going to go to our education credit, okay? We're going to get our 8863. So line 50 on the 1040, 8863. Okay, we're going to put Janet in there. Oops. All right, and we have her information. All right, she went to Buffalo Teachers College. Okay, we have the address for it there. Okay. All right. Oops. And we have the employee identification number. And again, this is just like we've covered before with our refundable credits. We get down here and says, has it been claimed? Yes, she's in her master's work, so she has claimed it. So if we do yes, kicks us right down to the lifetime learning credit. All right. If we take a look on there, she had $3,800, no scholarships or anything. So we're going to put the $3,800 in there. Okay. So in this case, with the $3,800, we put that in there. If we look up in the blue box, she has a federal refund of $873, and she has a state, or they have a state, I should say, of $460. Okay. So that's what that is. Now, what I'm going to do is I'm going to compare that to my tuition and education, okay? So if I go back to that sheet, what I'm going to do is take it out of there. I'm going to go to my 1040 page 1, go down to my adjustments to income, and I'm going to take a look at this tuition and fees deduction, okay? So I'm going to go in there. I'm going to get my worksheet. It's actually on the bottom of the one where we saw the educator and the student loan interest. So I'm going to go to the bottom, and here's Janet, and I'm going to put this in here for her for $3,800, okay? All right, so actually, her federal refund is now $683, and her state $705, okay? So if we add those together, by $55, it's a better job or better deal in the refund because of the increase in the state to take it as a tuition and fees deduction. So we would leave it there, okay? So you can see on some situations with somebody with income in a certain range, and if you take that education credit, especially if they normally would be in the lifetime learning for graduate school, and you put it on the tuition and fees deduction, sometimes it can amount to more of a refund. And you have to take into account the federal and the state together. Because remember, the state uses the federal adjusted gross income. This is an adjustment, so we need to make sure that we take that over there on that. Okay? So that is an instance where it would be better to take it in that manner. All right? Okay. Touch on a couple other things while we got a return here before we wrap up. We have I was talking about the different things that go on with these. If we take a look at our health savings account, when we go in there, okay, if somebody makes a contribution, we're pretty much, they have their limits. Down here at the bottom, it's going to ask for distributions. So if I took $1,000 out of there, all I have to do on 15 is basically say that I used it for health. If you look, there's a 20% penalty if I don't. But again, in HSA, if somebody is over retirement age and not working, they can use that with just not the penalty. But I would only have to put my $1,000 in there. So then that's the way that that's handled, okay? If I made a contribution out of my pocket up above, I would put it on here and it would show up an adjustment to income. If it's a code W on a W-2, then I don't put it on here because it'll carry over automatically. Okay, so say in this instance that I have, I'm going to say that he put in $750 from his pay. Okay, so if I have that be the case, I go to my 8988. All right, taxpayer, and it's a family plan. Okay, all right. then I know that that $750 would carry over for him, okay? So that I know that his contributions would have to be less. All right. The other thing that we see on the 1040 down there in the adjustments to income. All right. Again, we can see our adjustments here. Okay. Educators' expenses. Moving expenses, as I said there, if we had this case where they were moving, there's a little chart right at the top. You can determine what those are. It even has here little thing for the miles driven, other travels and lodging. So it has all the information you need and everything that you need to inquire about as far as what they need to do to take that that moving expense deduction. So great little form that TaxWise uses on the 3903. Okay. All right. SEPs and simples that we talked about a little bit. If you take a look at these, this is where the self-employment is. It may talk about where this is based off of because things will come over as to what they can contribute. But if you look down here, there's a lot higher thresholds for the SEPs and the self-employed and the simples and all those. For the contribution limits, it's not as limited as would be what you see for the adjustment on an IRA deduction. So for a self-employed person, that's always something to pursue there. Okay. All right. And that pretty much covers everything. Alimony, again, alimony paid, you have to have the Social Security number of the recipient. So the ex-spouse, you need to know what that is and take that on there for them. Okay. All right. Any questions on anything? Okay, again, I recorded today. I know the one return I did a lot of extra jumping around stuff. I will send some things out for that, okay? But that's kind of where we stand for today. All right. I am going to be sending out the midterm. As soon as I get done with this, get the recording set up, I'll send out the midterm. There'll be instructions on how it will go out. It's a computer midterm part of it, so it's one family, kind of a tax return that has a little bit of everything we've covered to this point. All right. So once I get that back from everybody, I'll get them graded and I'll send out your grades on both of them. Like I said, I've pretty much graded everybody's written and they've looked great so far. Okay. All right. Any questions at this point? Yeah, it's always good to run both education credits. Like I said, the thing about it is if it's somebody that's a dependent that is of age for the American Opportunity, 99% of the time that's going to be your best bet because it has that refundable $1,000 portion, okay? But if you have somebody that is like the taxpayer or the spouse and, you know, it's taken one class, like in this instance, she was taking it for her graduate school work as a teacher, sometimes it's very good that you have to visit both of those and see which one is better. This case, it was about a $55 difference, but that's $55, you know, so whatever the amount is, you know, for you to sit with a client and say, hey, let's take a look at this over here and see if we can get a little bit better tax return both on your federal and your state. You know, it's really that over and above customer service, okay? All right. So homework-wise, we're going to be covering 13 and 14. So I will send that out as a reminder with the midterm, but just for you guys that are here, chapter 13 and 14, have you read and do the exercises there. We'll talk about and do the problems. We're going to be getting into, we'll be spending class basically on self-employment. So that is for those business Schedule C people that are sole proprietors, things like that. A lot to cover, not a lot. We'll probably spend some time reviewing the midterm, depending on people did. Like I said, with my in-class that I've already taken it, there was a couple spots that were little stumbles that a lot of people fought a little bit. But remember, and again, only for those that watch the video, you're going to be able to text or call me. I do ask that for your get out of jail free, that you preempt it by that so that I know that you've watched the video or you were here. So if you have your question, please put in the subject of the email or the text that it is my get out of jail free card, okay? So that I know that everybody's been online watching the videos, okay? All right. As far as the number, use the online instructor, okay? That one seems to be working all right. I'm receiving emails there just fine. It just was a little snag with sending out a large group. That one, as far as the phone number, it's 716-982-6629. That's my cell phone. You can text me there. So, you know, my email comes there too. Sometimes it's a little slow getting the email, but obviously the text will come there. And remember, get out of jail free. All right. All right. Thanks everybody for this morning. Again, nice short lecture. Very shortly, you'll be seeing the midterm, computer midterm, and the instructions for that. So if you have any other questions, let me know. Oh, 982-6629. Okay, 982-6629. Okay. All right, everybody. Enjoy the time. We'll catch up with you. Again, no class this coming Saturday. I'm sure everybody will be returning from Thanksgiving dinner or travel. I don't want to have to interrupt in that. My one class is actually a classroom and an office we have in an outlet mall, and I usually teach on Fridays, so the last place I want to be on Black Friday is an outlet mall trying to find a parking spot to teach class. So everybody's off for this coming week. We'll be back at it on December 2nd. Thanks. Bye.